Hello and welcome to Nirmal, ladies and gentlemen. I'm Hiral Dadia. We have with us Mr. Amol Joshi, founder at Plan Rupee Investment Services, joining us on the show. And you're watching The Financial Coach. Welcome to the show, Amol. And overall, if you go to see, these have been uncertain times for every investor, may it be a new investor or a seasoned investor as well, because the kind of circumstance, this kind of situations that we have been falling, we are seeing ups, we are seeing downs, but we don't have any certainty as to for what kind of timelines would these actually continue. Now, taking that into consideration, Amol, it's very important to actually understand as to how important it is then to build or construct your portfolio versus doing ad hoc investments. And that's the theme that we will be concentrating on in today's show. Welcome to the show, Amol.
Hiral, thank you very much. Thanks for having me on the show. And I think you actually hit the nail on the head with so much of uncertainty that all of us have seen over the last 1.5 to 2 years. This could not be more appropriate to have a show on for whom portfolio construction is important. So let me start with an example. Suppose you are a cricket fan and there is a cricket match in a different city, and now you already have tickets, you are very excited to go. What are the plans that you will make? You will at least make a plan that your vehicle is in order. You will make some preparation couple of days prior to your start of the journey. You will account for some traffic and then maybe allowance of maybe 1 or 2 hours because you do not want to miss that match. Now, all these exactly, you can do the same thing in your financial journey. The simplistic name that we can give to that is financial planning or portfolio building or a portfolio construction. Portfolio construction is important for newbies as well as seasoned investors, simply because portfolio gives direction to your financial goals, your important financial milestones that you want to achieve in your life.
Absolutely, and that's something which is very crucial. So if you have to deep dive into constructing or building a portfolio, what are the key steps that one should look at to go ahead and build a portfolio according to you?
Right, Hiral. So let's take a deep dive. In my practice over a couple of decades, I have come across 2 types of investors. First set of investor, it's somebody who says that I have this 1 lakh rupee, I have this 5 lakh rupees. How can I put it to best use? Because these days, everybody understands that saving account or fixed deposits are neither tax efficient, nor these are high return or inflation beating assets. If I'm getting only 2%, 2.5% in saving account, I should just put this money somewhere. So that's first set of investors. Now, this set of investors typically are motivated. All human beings are motivated by greed and fear, but typically this first set of investors, simply because there is no plan that guides those investors. So coming to the second set of investors, these set of investors actually are much less bothered about the market movements, much less bothered about what is today's nifty movement or which sector auto is doing well and pharma is not doing that well. These investors are actually more bothered about, I want to accumulate 50 lakh rupees for my child's education 7 years later. That's the definition of a financial goal. You should have time in front of you, you should have amount, and you should have a clear demarcation of how am I going to, clear plan of how am I going to reach that goal. Now, when your goal is so much crystal clear, 7 years, 10 years later, 50 lakh rupees, and for child's education corpus, you will not be swayed, you will not be affected with the day-to-day market movements. Now, coming to the crux of it, what are the building blocks or deep dive of portfolio construction? I would say there are 3 building blocks on which your portfolio construction should take place. First and foremost, financial goal. As I mentioned, typically, each person financial planning differs for each individual, but typically I have seen that most of the people have following goals. You want to purchase a big asset. It could be car, it could be down payment for the house. That's number 1 goal that many of the investors do have. Second financial goal, slightly at a later stage of life, let's say 30, 35, maybe 35, 40, is you want to, if you have a large loan, let's call it a housing loan or a home loan. Home loans typically are for 15, 20 years, but nobody wants to service loans for 20 years. I want to clear off that loan in 7 years. That could be second goal. Third goal is child-related goal, child's education corpus creation. Fourth goal could be a retirement goal. And last but not the least, I just want to accumulate 5 crore rupees. You can call it a wealth creation. So these are largely the financial goals that most individuals, most normal investors and individuals will have. So financial goal is number one, first building block. Second building block is your risk appetite. Now, we all have seen and heard that over last 1 year, market has gone up in excess of 80%, small caps have delivered 100% or more, and we haven't even seen a 10% correction for last 18 months. So the environment for equity, barring maybe last few weeks, the environment for equity is pretty gung-ho. Now, you should be somebody as an investor who should be prepared to invest in equity only when you can tolerate a 5, 10, 15, 20% kind of volatility in portfolio on and off. And once in a decade, a crash of 20 to 30%, like what we saw sometime in 2008, which we call global financial crisis, or last year, what we know as a corona crash, corona-led lockdown, and the resultant crash. Risk appetite is something you should be able to benefit from. You would be able to benefit from the asset class only when you stay a complete market cycle in that asset class. If you just look at robust equity returns of last 1 year and you want to make a quick buck, there is a chance that you will be disappointed. So risk appetite is something very, very important. And I would say third building block of any portfolio construction or in financial planning is your asset allocation. Now, again, all of us have seen investors at all sides of extremes. I know somebody who says, boss, I only believe in gold because that's only asset which I can, I can liquidate 12 o'clock in the night also, and I will get a fair market value for it. There are some people who actually swear by real estate. It's an asset which I can touch and feel, and that will not run away anywhere. A share might go to zero, a stock might go to, a company doesn't do well, stock might go to zero. But my real estate, my flat that I own or a piece of land, it will not go anywhere. Now, all these extremes do not help you as an investor. The simple reason for this is all asset classes do not move in straight line. So we have seen last 1.5 year, equity has done very well after a big crash, but gold has not gone anywhere. Real estate is probably flat, or it has not even beaten inflation over last 7-8 years. So long story short, you should be somebody who pays a lot of respect and based on asset allocation builds your portfolio. Last but not the least, I do not want to ignore fixed income asset classes. There are people who just say that, boss, I invest in PPF, FD, all the government instruments. But other than PPF, most of these instruments are not tax efficient. And we have seen over the years that they do not beat inflation on a post-tax basis. So asset allocation is the third building block based on which your portfolio construction, your portfolio, how you should go about building your portfolio.
Right. A key aspect, Amol, that you mentioned about asset allocation as well right now. So we've spoken about the steps and the factors that one should be considering to build a portfolio. Now, breaking up further in terms of asset allocation, we've spoken about which are the different assets it could be. However, for a beginner, what are the assets which are best suited according to you?
Right. So for a beginner, biggest fear that any person who starts investing is, I hope I will not lose my money. That's the biggest fear that any individual has. Everybody, hard-earned money, you slog for it. You do not want to lose that amount of money. So I would say it is contrary to the thinking. If we go by the traditional rules of thumbs that your equity should be 100 minus your age. So somebody who starts earning at the age 25, that person, one would typically recommend you should have a 75-80% of asset allocation into equity. I do not doubt that because youngsters definitely have much longer investment horizon. A person who is 52 plans to retire by 55 or 60. That person hardly has a 2, 5, 6 years of investment horizon. But somebody who has 25 years, 22 years started earning, that person, that individual has much longer investment horizon ahead of himself or herself. But suffice to say that first and foremost, you should have some allocation towards debt. And luckily, we all have some allocation towards debt. Whenever somebody starts earning, our well-wishers, parents, typically we would get advice, boss, first and foremost, please open your PPF account.
Correct.
10 or 20 years back, it used to be, please start with your LIC policy. I think that now has reduced a lot. Now, second advice, after first advice, PPF, the second advice is typically a mutual fund SIP. So as a beginner, you should understand that you should make a sound foundation via a fixed income portfolio, and do not be afraid, do not be shy of starting with equity. Now, slight repetition probably in the message, but always remember that equity is a proven asset class over last several decades, maybe centuries, that consistently beats indexation. It also has favorable tax treatment. So somebody who is in the highest tax bracket of, let's say, 30%, a fixed deposit interest is taxed at the rate of your tax bracket, which is 30%. But for equity, be it equity stocks and shares or equity mutual funds, the tax treatment is long-term capital gain tax beyond holding period of 1 year is taxed only at the rate of 10%. So there is a significant amount of money to be saved via a tax outgo. Coming back to the topic, a beginner, after understanding the risks that equity has and rewards that equity offers, including the tax efficiency, including the ability to beat inflation, including the ability to participate in a business at a small contribution. You want to set up a company, it's not very easy. I cannot do it, at least. But you can probably buy a top tier bank's shares and become a part owner of that bank. So after understanding the risks and rewards, advantages and disadvantages of equity, start in an asset allocation manner. Consider, along with PPF, consider a mutual fund, especially the regular investments via SIP. There are other products also that we can very quickly touch upon. There is a precious metal asset class. You can probably have a 5%, 10% allocation towards gold. And as your portfolio size increases, I would recommend international diversification as well via investing into a US based or international funds.
That's a nice comprehensive portfolio to look at as well as a beginner. And with this, what are the key risks according to you that an investor who's a beginner should keep in mind?
Right. So risk is a very important factor. We cannot ignore that. So there, within risk, I would say basically what most investors understand by risk is, I had invested 1 lakh rupees and market crashed and my 1 lakh rupee valuation became 90,000. For an example, 10% crash in the market. Now there are two things from here. There are two ways in which your portfolio can progress. The first is paper loss, as in you invested into equity with a 3-year, 5-year horizon. And after making a journey of 6 or 8 months only, you saw this crash. You know very well that there have been multiple crashes like this, including the last year's crash 2020, which is very fresh in all of our memories. But we not just came out of that crash, but we went several percentage points over. Basically, we beat the old all-time highs and we made new all-time highs. Now, once you have this conviction of equity will doing well over a medium to long-term period of time, you just stay, you do not redeem, and that just is a paper loss. As and when market recovery takes place, it could be 1 quarter from now, it could be 6 months or 1 year from now, your paper loss again gets converted to profit. Again, your investment comes back into the green. It is no longer red. That's the first thing that can happen. And second thing is, you simply lose your cool. You have no stomach or you have no risk appetite. If you do not have that, then I would say equity investment itself is not your cup of tea. It is not necessary that all, as a population, we very much know this data. As per eligible population, hardly 3 to 4% investors in India invest into equities or mutual funds. So there is a vast majority of people which, for multiple reasons, including lack of awareness to risk appetite, all of these reasons, people are not investing into equity. So it is not mandatory that you should invest, or even if you understand all the risks, do not have the shorter time horizon. So do not let your paper losses get converted into actual losses. That will happen only when you press the redeem button at the peak of market negative sentiment, or at the stage where markets have not really done well. So the risks in the portfolio is you not understanding what an asset class delivers for you and investing into it. It's my recommendation that all of us should know advantages, disadvantages, risk, rewards, and inherent characteristics of each asset class before signing on the dotted line, before actually going ahead with the investment.
Right. And Amol, my last question coming to you is, Do you think this is the best time to start building a portfolio, number one? And two, what's the kind of minimalist, I mean, which is the best asset class to start off with if you have to start off at this time of the year?
Right. So we for the answer of first question, I gave a little bit example or a story of the cricket match. Let me end with one as a last question also. So you said, is this the best time to build a portfolio? There is a saying that best time to plant a tree was 20 years ago, and the second best is today. Meaning, if you have not started constructing your portfolio on the building blocks that we discussed just now, if you have already not done that, the next best or the best time to do it is definitely now. But I can understand why you probably asked this question. During our discussion, we referred to one of the points that market is close to maybe 7-10% of the highs, but psychologically speaking, market is at elevated levels. Sensex at 58, 60,000, something like that. Now we all should understand there is no ceiling to where a Sensex value can go. When Sensex started at 1979, the value was 100. And we have seen a 60 or 62,000 number hardly couple of few weeks back. Since as the companies generate profit, the share price follows, not necessarily in a straight line. Again, that also we have discussed. All asset classes or even the share prices do not move in straight line. But over a period of time, if the companies have sound businesses, and if companies generate churn profit year on year, quarter on quarter, the share price invariably follows. And the market will go from this level also. Market will probably scale newer highs, maybe 1 year, 3 year, 5 years down the line. So I would say, is this the best time to start constructing your portfolio? If you already haven't started, yes, this is the best time. Number one, you also spoke of which is the best asset class. Now, this is something again very important. PPF typically has a 15-year of time horizon, and first 5 or 7 years you cannot even redeem amount from your PPF. So PPF, somebody can say PPF has a triple E taxation, exempt during contribution, the interest accumulation is also exempt, and once you redeem after 15 years, once you withdraw after 15 years, the entire corpus is again tax free. So somebody would say that was PPF because of triple E taxation is probably the best asset class. But the difference is PPF has annual maximum investment limit of 1.5 lakhs only. And it has lock-in in the initial 7-year period. Each asset class, you should look at what is the taxation, what is the risk and return profile that an asset class has, as well as if there is any lock-in. Only for tax saving, if you invest into mutual funds, those mutual funds have a 3-year lock-in. Now, if you want to invest only for 6 months or 1 year, tax saving mutual fund is probably a wrong choice for you. But quickly to wrap up, I would say you should have some part, a decent part based on your risk appetite into equity assets to give your overall portfolio ability to beat inflation over a medium to long term. Here.
Absolutely, very well put, Amol, and it's very comprehensive as well for a new investor to understand what you've said. Thank you so much for joining us on the show. As always, a pleasure to speak to you. Post this, I think let's catch up once again over the new year and deep dive into a couple of points and see how the investors can benefit out of it. Thank you so much for watching The Financial Coach.
Sure. Thanks for having me and looking forward. Thank you.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.